Round, round, get around, I get around, yeah, get around, round, round, I get around. And that's the question that shareholders are wondering about StoneCo, STNE Stock. Will Stone stock get around to its prior high, which might suggest several 100% upside from here, something like a 6x plus from here? This is a stock owned by both deep value investor Warren Buffett's Berkshire Hathaway, as well as Cathie Wood and her innovative ARK ETFs, I believe ARKF, her Fintech ETF. So the question is, where does StoneCo go from here? What do I think about its valuation? What did they even do? We'll cover it all in this video. If this is your first time tuning in, my name is Daniel, and you're watching Unrivaled Investing. This is a no hype mission focused channel trying to find you exceptional tunes, exceptional stocks, unrivaled investments. And if you enjoy this channel, please make a point of hitting that thumbs up, hit that subscribe button. And in full disclosure, this is not financial advice. And at the time of this video publication, I did not yet own stock in Stone, STNE. So Stone is having a marvelous day, up over 40% just today. But the reality is that despite today's rally, it's still down something like 85% from its recent high. Now, that would suggest that if you do see a recovery back to that price, you have hundreds of percent upside. Now, part of that price was because it had a very lofty valuation. So let's see towards the end of this video where I talk about what do I think StoneCo can do in the years ahead. But looking at Stone right now, really the business really comes down to two different segments. You have financial services, where they're effectively enabling merchants to accept payments. So a lot of this business is called merchant acquiring. This is in Brazil. Another aspect is software, where they're providing critical solutions for small merchants to run their business, maybe like an inventory management or even just being able to sell something online. Now, historically, they've grown at very fast rate. This isn't just a flyby, just a random idea that just suddenly took off, or a SPAC that's unprofitable and you go, hey, how come the stock's down significantly? This is a very real business that's grown quite significantly over time, with literally millions of active clients using their payment gateway. And you can see the payment volume has grown quite significantly, up 54% in the fourth quarter. And keep in mind that payments, as they have more and more payments going through them, they get a cut of that, and that drives their revenue. And as they take, let's say, a higher cut, they're going to see even better revenue growth. So you're looking at 87% year-over-year revenue growth, which is exceptional. Now, they've also had historically very, very high profitability, 35.7% adjusted net profit margins, which is quite high. Now, they did have some problems in 2021. You look at a sizable loss in the second quarter, and more recently closer to break even. Now, this did cause some uncertainty for the business. Now, part of this was because of some payment solutions that they have, credit solutions. But what does management do? Do they own up, or do they just completely sort of hide under a stone, or just ignore it? What do? They call out saying 2021 was an unsatisfying year for Stone. We executed well in some areas, but faced challenges in others. We believe our market opportunity is huge and merits an aggressive approach, but we tried to do too much last year and did not execute as well as we would have liked. Our aggressive commercial approach, combined with a challenging macro environment, impacted our profitability. So they're saying our results weren't as good as they could have been. We saw a problem with our profitability. We saw a hit to what our profits could have been. In credit, we ramped up our offering quickly, but did not manage it well. Okay, so I got to give management a lot of credit here, because they're owning up. They're showing some real character here, saying we goofed. We want to be aggressive because this is a huge opportunity, but we move too fast with some of our solutions, like credit offering. I did a whole other video talking about Stone. In that, I talked about some of the problems with their credit solutions, and that's part of the reason why the stock did take a hit. But I like seeing the management saying, yeah, this was unsatisfying, and we didn't do great. If you're wondering why I'm saying unsatisfying that way, it's Teddy KGB. That's why I'm a fan of rounders. So while Stone's credit solution was a real snafu in 2021, that did partially cause investors to panic sell the stock. It seems like management has learned a lot from this experience, and they're quickly moving forward. And, look, that's the trick in life. You got to keep moving forward if you get knocked down. And so the reality is this doesn't look like it's going to be a lethal blow. They're even talking about how since effectively this legacy credit portfolio has been frozen, despite, sending out several billion reais, they are expecting to effectively get all their money back. And this was a real problem, because you can see their portfolio is valued around 850 million reais of which they're reserving about $500 million in bad debt. So this was highly problematic portfolio. But if you step back and realize, wow, this core business is still growing quite significantly. You have record high net adds in terms of new micro, small, and medium merchants. And, this merchant base is growing significantly over time. And not only is it growing nicely, but you see, very strong record volumes across their business, and they're getting a higher take rate because of the value that they add. Now, management, part of the reason why the stock's doing so well is management is guiding to really strong continued growth in 2022. You're looking at 113% to 119% growth year over year in their first quarter 2022. Now it's around 70% if you exclude the impact from their Lynx acquisition, which was in software. But overall, very strong growth. They're talking about strong profitability, and they're saying, look, we're going to be focusing on improving margins. This is what management, this is what shareholders like to see, especially given the fact that if you just look at their most recent results and you annualize it, you're looking at very strong growth. So how should we think about Stone's valuation? Normally, I do a quick plug about unrivaled investing and how if you're looking for a community of investors looking for potential multi-baggers, you might want to check it out. Click Join the Journey. I'll skip that full plug and let's dive right in because I think you've heard it before. And so looking at StoneCo, Stone's valuation is down so significantly over time. Now, it arguably did get too frothy in, the end of 2020, the beginning of 2021, around 40, 50 times sales. That is just really frothy territory, and generally stocks in that territory have a rough go of it. Now, however, it's trading at arguably half the valuation that it was during the COVID panic, COVID pandemic in March. Subsequently, things recovered during, the response to COVID. But really, when things really, started going south, you saw the stock prices just drop so significantly. It was trading around high single digits. Now it's half of that. And so looking at their business, I love their software and merchant acquirer business. That said, they have been leaning more into sort of banking type solutions, financial services that are much more capital intensive and require access to the capital markets, and occasionally their own balance sheet. And so this does make me a little less comfortable because, hey, if you're in the business, you're saying, hey, we are a merchant acquirer enabling merchants to accept credit card payment or accepting payments of different sorts. That can be a very lucrative business, and they've shown that already, and that's been a hyper growth business. But they're layering on banking services effectively to sort of round out their offering and to grow even faster. And those banking services can result in them saying, hey, we'll provide cash to all these merchants, maybe some prepayment, maybe for their credit card portfolio. And that has been a source of problem in 2021, and it's a huge capital use for their business. And so that's what I look at, with this business where they're saying, hey, our adjusted free cash flow was nearly break even for the year. Now, they did do some, smart investments that management talks about. Management talks about, hey, we sort of went heavy on buying inventory in the fourth quarter because we're not so sure what the supply chain looks like in 2022. We want to make sure we're able to continue to grow really well, and we want to make sure our physical point of sale units, we have plenty of them for merchants. So I think that's a smart move in terms of seeing a loss in the fourth quarter. But, broadly, what you're looking at in 2021 was a huge investment in prepayment cash needs, continued huge investment in the fourth quarter 2021. And so that is, this makes the business trickier because then you have to find other counterparties to effectively sell receivables or issue debt. And, whenever you're sort of relying on others with a business model, it makes me a little bit more uncomfortable because you're effectively saying, yes, as long as the capital markets are working and as long as we can sell receivables or as long as we can issue debt, it won't be a problem. But someday, if the capital markets really tighten up, you might be stuck holding the bag. And do you want to have that credit risk? And that does sort of increase the risk with StoneCo that I am mindful of. But overall, looking at the situation, I really like the setup here. You have a collapsed stock price, hyper growth, profitable business, and a very reasonable valuation at around 3 to 4 times sales. I would love to hear you comment below about companies that are profitable, growing at their rate at 3 to 4 times sales. You won't find very many. I think this is a great setup for potentially huge returns in the coming years. This is my upside potential framework that I'm looking at, and in one upside scenario, you could see over 300% upside. Now, this is a hypothetical valuation. So of course the stock price can go higher and lower as it depends on the execution and sentiment. You could see what a huge impact execution had on the company this past year. Another key aspect investors need to consider is around country-specific risks. Specifically, Brazil, you have uncertainty around inflation, unemployment, and rule of law. But broadly looking at this company did report much higher margins in the past, so I think I'm being conservative here, saying 20 to 25% growth. If you annualize their fourth quarter or their first quarter results, you are looking at somewhere between 60% growth, maybe higher. They're guiding to like 115% growth for the first quarter. So I'm penciling out 60 to 80%. I'm saying in the ensuing years, maybe 20 to 30%, and an N multiple of 15 times to 20 times, partly to account for the very specific aspect, the geography of being in Brazil, and you do have this uncertainty around high inflation, high unemployment, and potentially even the rule of law. But broadly, I look at this, I like what I'm seeing. I have not yet pulled the trigger. Unrivaled Investing Journey subscribers will find out if I do pull the trigger, but I'm very, very tempted to. Partly the reason what's holding me back is I'm looking at another company. I'm tempted to call it out as my potential multi-bagger this month that has broader geographic diversification, is much more of a consumer staple type business, 5% dividend yield, trading at 11 times earnings. So that does look really compelling to me because I'm thinking, oh man, this business can re-rate maybe to 15 times and maybe you get that 5% plus 5% growth. So I like thinking about the different setups. It really just comes down to opportunity cost. What do you think? But maybe I'll ultimately own both. We'll see. If this video has been helpful for you, talking about StoneCo, a little Beach Boys introduction. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button, and thank you so much for tuning in.